Every year I've come here for quite a few years now, and I've given the same speech. What are the changes to super? And it's always been something different each year. I don't just tell the same stories over and over again. This year I got heaps though. So this year I've had to cheat a little bit. So these are the super changes just here. I'm not going to talk about every change in detail. I'm not going to talk about that legislation in detail because I did it in the webinar in December. And so if you want to go through, what those legislative changes were, etc., that's available on our YouTube, on the net, or click through the link on the slides that have been emailed to you. And I specifically focused on that, on a lot of these, issues in the transfer balance cap, and look at them all the different issues, explored each one of those, and how they work and what they mean under the legislation. So there's lots and lots to get our head around, and certainly not enough time before your drinks this afternoon. We'll go through a few different weather systems before I exhausted all of those options. So what I'll talk about instead is Benny. And so Benny here, he's got super benefits of 1.65 million, and he hasn't triggered his bring forward cap. How much can he put in super? So remember, you could, if you've got $1.6 million worth of superannuation benefits, you're not allowed to put any more non-concessional contributions into super. So from a non-concessional contribution perspective, after 1 July, Benny can't put in any more money into super. But of course, before 1 July, those rules don't commence, do they? So he hasn't triggered that bring forward cap, so he can put a whole $540,000 into super before 1 July, before 30 June really. What if he doesn't have the money to put in that 540 and he wants to maximise those benefits? What can he do then? So he might be able to borrow. If he knows some money's coming in August, he might be able to borrow off the line of credit in his home, put that in and non-deductible debt, but he knows some money's coming in, so that's going to get paid off soon. If he waits until 1 July, well, he's stuck. He can't put any more after-tax contributions into his super fund anymore. I guess in this case, he could have a look and he could try to take, if he was over 60, he could try to take $50,000 out, so it was under that 1.6 mil, but he can only put $100,000 in next financial year, so it doesn't really achieve that much for him. So this is a bring forward cap. So if you've got more than $1.6 million in super, you can't put any more money in come 1 July. If you've got $1,599,999, you look at the, on 30 June 2017, you can still put in a whole $100,000 into super, even though it's only $1 short of the 1.6 million. And the same applies then if it's 1.4 million, if it's 1.499, then you can put in $200,000. And you can, if you trigger that bring forward rule, you trigger it by paying $101,000, and then you got your $99,999 left. And this is going to continue on. The 1.6 million cap obviously will be indexed in $100,000 increments over time, along with the transfer balance cap. And so you have to have a look whenever you're making a non-concessional contribution of what your total super balance was on the prior 30 June. And so, if you've got that real-time accounts and you know exactly what your super fund's looking like on 30 June, you're in a better position, aren't you? Jolene. 40.
38.
38, sorry. Total super balance of $900,000. And she made a non-concessional contribution of $200,000 on 1 December 2016. How much can Jolene put in before 30 June this year? So she's still got access to that $540,000 bring forward, doesn't she? So 540 less than 200, that's 340 she can do before 30 June. What if she doesn't? What if she doesn't put any more in this financial year? How much can she put in next financial year? So there we're looking at, okay, well, we triggered the bring forward cap, the bring forward rule this year because we put in more than 180, we put in 200. So this year the total cap was 180. Then we look at next year, so financial year 18, it's 100. Financial year 19, it's 100. That's the 3-year bring forward rule. So if I got my lawyer maths right, that's 380. So 380 less than 200, it's $180,000 that she can still put in over the next couple of years. What if, instead of putting it in December, she put it in say, June 2016? So she put it in financial year 16. So then, yeah, so she triggered it in the 16 year, the cap was 180 then, and then 180 for this financial year, and then the 100 for next financial year. And so that's the 260. A few people are looking at also, so now we've got the $1.6 million is the most that you can have in a tax-free pension. And so here we've got, there's a strategy of equalising balances. So Ryan's got $2 million in member benefits and Jackie's got $1 million member balance. So Ryan, he's met a condition of release, he takes $500,000 out of his fund, gives it to Jackie and she puts $500,000 into her fund. Then when they're going into that retirement phase, they're both maximising the amount they can have in that tax-free super account. So a lot of people is really focusing attention, these changes on 30 June, on maximising contributions into super. So people are trying to get that $540,000 into super before 30 June, and people are looking at getting, can I get my business premises into super, or can I get commercial property into super because I don't have 540 cash lying around. Another concern that people have is they never stopped the CGT cap under all of these rule changes. So a couple between them can put in, about $2.8, $2.9 million under that CGT cap if they met that 15-year retirement exemption rule. People are concerned that in this next budget, they might be changing that and they might be marrying it up so it matches, the 1.6 million cap and it matches the super rules some more. There's always speculation, what might and might not be in the budget. I don't have any inside knowledge there, but people are concerned, and so people are looking, okay, well, before they change those rules, can we get this property into super and can we get it into there? Well, we've got access to that generous CGT cap and we've got access to the $540,000 bring forward rule rather than the $300,000 bring forward rule, and we want to get it in there before we reach that 1.6 and we can't get any more in. So the good news is we've done quite a few of these in the last year where certain types of, like a lot of business premises, a lot of commercial property are owned by family trusts. And those family trusts, when they've got those default beneficiaries, which is when the trustee doesn't make a decision before 30 June of where to distribute income or capital, it goes automatically to those default beneficiaries, and quite often that's mum and dad. So when we can line up mum and dad as the default beneficiaries of the discretionary trust, mum and dad are the members of the super fund, we can transfer that property into super without stamp duty. And we can have the bare trust, etc. there too. And yeah, you guessed it, there's a animation I've done on that explains exactly how we do it. So follow the link in the email, in the PowerPoint we sent out. What other uses do we have to these declarations of trust? So of course we can transfer that business real property to super, access those small business concessions. I'll talk about this one next, so I won't talk about this one now. Transferring property out of super without duty. So there's people who've got the pre-99 unit trusts, or you want to get property out so you can live in it as your holiday home, or someone's died and you want to keep the property within the family, you don't want to sell it. So we can manufacture, have a discretionary trust set up outside, and we can do it in reverse, so we can transfer that property out of super without that stamp duty. Ungeared unit trusts, this is a structure that's used for residential property sometimes. So the family trust owns some units in a unit trust and the super fund owns some units in a unit trust. And then over time the super fund buys the units from the family trust. So if we set it up with those default beneficiaries, well, we don't have stamp duty on each one of those transactions, just got to worry about the capital gains tax. The other one is quite often younger people aren't ready to buy their business premises inside their super fund yet. They prefer to have it in a family trust. But when we're looking at that, why don't we set up the family trust with those default beneficiaries, so then in 5 years' time or 10 years' time, we've got that option to get it into super without the stamp duty, providing they don't change the Duties Act. And with that, if you've got a bit of equity in your property outside of super and you've got a little bit of cash inside of super, it's pretty easy to transfer that property into super subject to your relevant caps, and that's something that we specialise in. And there's quite a few people in the room where we've used those different strategies with. So this is a novel one. So with And I thank Terry Ahern, our bank manager, for this one. I've done a strategy like this before where I actually paid the stamp duty on it, and then Terry said, "Oh, well, can you use that same declaration of trust in this occasion?" And so, under your general limited recourse borrowing rules, right, you can't buy land and then borrow again to build the building on it. So, in this occasion, we had a client where they found the perfect site and they want to build their factory on that site. But of course, we can't borrow in the super fund and then borrow from the bank and build a building. That's changing the nature of the asset. We're not allowed to do that. So using the declaration of trust, what we do here is we've got the super fund's got $1 million in it. We set up a discretionary trust, and the land that they want is worth $1 million, including your stamp duty. What we do is we get a contract at the front end where the bare trust contracts to buy the land with the factory on it that's worth $3 million. So it's got those specifications on it. The super fund pays that $1 million over to the discretionary trust, and then the discretionary trust, it puts that land up so the bank can get a mortgage over it, and it gets a construction finance from the bank. So then it builds the building, and a year later it's got the purpose-built factory that they want to run their business from. We have to pay stamp duty, of course, on that initial land acquisition. What's that? About $40,000 or something on $1 million. And then we refinance that last bit, so we borrow as a limited recourse borrowing arrangement in the super fund from the bank, and we repay the loan to the family trust. And even if this process has taken a couple of years, because we had that contract at the front end, there's no capital gains tax event really for the family trust, even if the property market's gone up in the meantime, because your capital gains tax event's when you sign the contract and they're both matched up with their prices then. So, that's a good strategy for people who want to use that equity in super to build their own premises. Too bad that where we did this before, the client actually paid that duty twice, once on the $1 million and then once on the $3 million. So I hope they don't hear about this strategy. So with the $1.6 million cap, so your transition to retirement income streams are going to be subject to a 15% tax. They're currently tax-free. And then your other pensions, if you've got more than $1.6 million in your pension account, you've got to reduce that by 30 June back to the $1.6 million level, or you'll get some penalty tax. So what people can do before 30 June, of course, is they could sell any assets that have got big capital gains in them, and they wouldn't be paying any tax on that. But kindly, the government's given us some transitional measures so we can keep those assets, those shares, those properties inside a super, and we can have a deemed capital gains tax event. So that's in any of those circumstances where we're got a transition to retirement pension, or where we're reducing our pensions to the $1.6 million amount or less. And there's a few complications with it, etc. And I talk about that in a video, another one of these animations. Now, what you have to do is you have to have some kind of action where you're changing your current state of your pension. You can't manufacture a new state of affairs. You can't suddenly have a segregated pension asset when it wasn't in there before. And then it's where you make the election after you've had that event. Where you make the election is when the next tax return's due. And so, most people in the room have got good advice, and most of the tax returns, they get that extended lodgement with the accountants, and when's that? That's sometime halfway through May. And so if that's the case, well, you've got a fair bit of time to figure out, am I going to make the election or not, and what am I going to make it with respect to? And if you do make that election though, well, it's like it's a deemed sale and repurchase. So if you sell that asset within 12 months, you're not going to get that general discount, so you're going to be paying 15% capital gains tax rate rather than the 10% rate. You even got the ability to, let's say you could even, let's say you had some big capital gains, if you had a unsegregated fund, and so in the accumulation part you had some big capital gains, and in your pension fund you had something that was a big capital loss, you might be able to manufacture that so you can use that capital loss to offset the current year's capital gains.